Hey, good morning, everyone. Steve Ankerstar, and welcome to the Ankerstar Wealth Morning Show. Allison will be off all this week due to spring break. We're going to talk about two things today. Most importantly, what's going on with Silicon Valley Bank, Signature Bank, the Federal Reserve and Treasury response this weekend, and President Biden just made his remarks. So we're going to peel that back. There's what they said and then what they mean by what they said. So I'm really going to kind of get into the details of what they mean when they say, depositors are protected, investors are not. So since you're an investor, right, or you wouldn't be listening, what does that really mean? You may already know it, but we'll, at least cover some basics there, and also go through and cover, about the banks overall and Dodd-Frank and some of the legislation piece of that. So I think you'll really enjoy that. Also, this morning, you can talk about two things. So as the banking situation will be one, because that's obviously, has huge impacts on the markets. And second one is the number one thing about retirement people aren't thinking about. I've had this conversation with, soon to be retirees lately, met with a couple late last week. And it really is an interesting point. It's a Harvard study that talks about the most important thing in retirement. Before we begin, though, as reminders, financial education presentation, you have to do your own due diligence. But before you act on anything you hear this morning, full disclaimer information is available at ankerstarwealth.com. Let's go ahead and get started. So, late last week, Signature Bank folded. So what happens when a bank goes down? Well, as you know, and you're probably going to learn a lot more if you're watching mainstream media about this, is you have FDIC protection up to $250,000 when you have your cash sitting in the bank. So okay, that makes perfect sense, right? So if you have more than that, like folks did at the Silicon Valley Bank, because a lot of startups, a lot of had huge accounts there. Well, if the bank folds, or then you're only going to get $250,000 back. So that's the kind of way that works. So people should consider not having more than $250,000 in the bank in one place. Now, before they, to peel that back a little bit, they're like, well, I have more than that in my Schwab account. Schwab's a brokerage. It is not a bank, and you don't have cash sitting there, right? You have equities and, stocks and shares and bonds and funds and everything else, private equity held within those accounts. And the way it works is Schwab or TD Ameritrade, any big brokerage house, to encourage you to have quite a bit of money with them, they provide the extra insurance. So they pay into the insurance fund. So your brokerage account is covered to whatever you put in. If you have $1 billion, you can put $1 billion in there, whatever it is. So you do not have to worry about those limits within a brokerage. However, back to the bank situation. So obviously not being able to get deposits out of a bank could cause a bank run. So that was the big concern on Friday when you have a big bank folding, is that are my deposits safe at Wells Fargo or down the street at our bank or First Citizens or wherever, or if you bank online at Ally or Ally Bank, I don't know which one it is. But are my deposits safe? Well, yes, they are. And then, so, if you go above 250,000, though, you are taking some risk if you're with one bank there. So, all right, so let's take a look at, President Biden was just on, and he said, basically this weekend, the Federal Reserve and the Treasury put out a joint statement. I put it on Facebook yesterday. I think it might be right here. Where they talked about they are going to backstop depositors and financial institutions. So that means there's a big bucket of money, if I understand it correctly. So again, not an expert here, talking to what I know. The banks pay into FDIC. Well, the FDIC has a big chunk of money that is exactly for this purpose, right? And if they need beyond that, then they're gonna set up a separate facility. They'll provide loans to institutions for up to a year, basically pump, basically when these situations happen, you pump money into it. So things don't, everybody can continue to operate while they figure out what's going on with the Silicon Valley Bank here, as well as Signature and some of the others that appear going to be caught up in it. There's a couple this morning that may be on their knees, if you will. So deposit, so you can get your money back out, or your money continue to be safe if it's there, because they don't expect everybody just to go in and grab everything. But use what you need, right, to continue operations. They're talking about folks trying, making mid-month payroll, that sort of thing. So what did now President Biden also said. So anyhow, that's how that goes on. So there's a chunk of money for that, and then they're also allocating another chunk of money to go in and backstop the situation. So we've got that. Does that mean you're free and clear? No. Who's not? Investors are not. So two ways to invest, right? You can either loan your money to an institution and then they pay you out at a fixed rate and they give you your money back when they're done. That's called a bond, right? So if you have a signature bank bond, you can expect that to go not well for you. We'll see. And then secondly, you could own their stock. Right. So when you think of, companies going under or getting bought or failing, the stock is going to, drop significantly. So let's see, what's the ticker for this thing? SIVB, I think, is the ticker. So we'll pull that up. So again, when company fails, the stock goes to zero. SVB trading halted. So you can expect that. Let's just pull up a 1-year chart. Well, let's pull up a 1-month chart. That's probably a little more telling. So trading's halted right now. Eventually that will open back up at some point in time, but you can expect the stock to crater, and you really just don't have any options there. When you hear people about holding the bag, well, if you're invested in a company and it goes under, the stock's going to go to zero. The bondholders will not necessarily go to zero. The bondholders are the first creditor in line, if you will, if the company has to be liquidated. So, basically think selling off all of the assets and then paying out to all the bondholders equally. So if they have, 100 million out in bonds and there's 40 million in assets, then you would get 40 cents on the dollar. If my math was correct, I think that was, and that goes out across everybody. Now, things tend to not literally go under and get sold off to zero. They tend to get bought, right? So somebody will probably roll. I don't know. This is no crystal ball here. But you would think that somebody would roll in and buy Silicon Valley Bank here, as well as Signature Bank, and kind of save the day for the bondholders. So either way, whether you're a stockholder or bondholder, which we don't have any exposure to this here at Ankerstar Wealth, but if if you're doing this on your own and you're kind of stuck for the time being. So I would just hold, even though the numbers are ugly, and kind of see what happens. There's no need. People are fire sailing these things, so going to basically drive it to zero. I would just hold on here and see what happens. If there's a bankruptcy associated, then the stock gets restructured into a new stock and gets reissued, sometimes at the same ticker, which is why if you've seen folks in the past are like, well, I have some United Airlines stock from 1962 or whatever, and it's just like, well, that's worth nothing, right? Because then it went through bankruptcy a few times or several times, and those are the old shares. Right. So those are worth nothing, even though the new shares are worth, whatever they are. So a lot more fallout from this. So we talked about, depositors are going to have access to their money, so they will not be penalized. There's a institution that, the FDIC backstops this. There's the Fed and the Treasury Department are coming in and adding some without it being a true bailout. Okay, so your taxpayer money is not going towards this. Investors are still at risk. And then the last kind of step that President Biden talked about is if the government has to step in and assist your bank, they're firing all the management. So two sides to that. Okay, yes, I like it from an outsider looking in of sure, throw everybody out. Was it everybody's fault that works there? No, it was kind of the joint decision, of all of them, how they structured the bank, the risks they took, and all of a sudden why they failed. So yes, in theory, throwing out all of the management is the right thing to do. In reality, you bring in a whole new management team. There's so much learning that would need to go on at the beginning that I'm not sure throwing out everyone is the best move. But What do I know, right? So I would expect that I think that probably will happen since the president just said it, but I'm not sure it's going to help Silicon Valley Bank or these folks get back on their feet if you fire, management to the tune of 50 people or so. So we shall see. But overall, you've got that's what's going on in the banks from an investment perspective. Yeah, I am looking at there's always some contagion, if you will. Contagion is the big concern. I think 2007 through 2009, you start to have banks fail and they're all interrelated, so others could fail because somebody else failed. I don't think that's the case here. I think it's going to be limited. There will be some contagion, there always is, but I don't think it's going to be a mass contagion issue. But we'll find out in the next couple of days who's affected, directly or indirectly. So there's no, in my opinion, no concerns for the financial institution, financial system, if you will. Now, regulation. Trump came in and relaxed a lot of the rules. I, being running a financial institution, cheered that, right? Because it helps a little bit. But I think this will, the point is this can't happen. And there's a fine line between regulation and still maintaining operations, right? So I'm sure there will be something that comes out of this regulation wise to try and protect everyone from this happening again. So we'll kind of have to wait and see. But from an investment opportunity for us, I am looking at the banks. I do think they will get hit in mass this week. There could be an opportunity to move in to the XLF, KBE, KRE is the regional, where the regionals are getting killed this morning. And possibly rightly so, right? They're just not as strong as somebody like a JP Morgan. But, there could be an opportunity to go in here and swing in and get exposure to financials. So when you're sitting at home and all of a sudden you see, you pick up a position in the XLF, that's right. Your stock sell off and then that's the time you buy, right? So there's some judgment there, obviously, as when to exactly we enter that or if we enter it, right? So that's something I'm going to be looking at this week to see if we want to allocate some money into this space. Okay, that's it for the first topic. Second topic is retirement. What's the most important thing? The number one retirement challenge that no one talks about except Steve. And a lot of other financial advisors. I'm not saying that I'm the only one, but sense of purpose, right? Is you retire and you leave potentially what you spent your whole lifetime working towards behind. Right. So they break it down into, what makes us happy in life. I'll highlight it here. What makes you happy? And I think there's really some insight here as to if you are a person that's happy in the workplace, one of us that loves our job and actually, looks forward to it and is very passionate about it, and you're doing meaningful work and it makes a difference and you're helping people or changing lives, that sort of thing is very, it gives you that sense of purpose, right? There's that piece, and there's also the social piece, right? Often the network of individuals that you work with throughout your career, as a career fighter pilot with the Air Force, and had a fighter pilot friend in town Friday, and it was just great to catch up. We talked about literally 1,000 people to figure out where they are and what they're doing, that sort of thing. It's just it's a community. Right. And I'm part of groups. So I still have ties back to the old fighter days. And then obviously I'm not flying anything at all, I haven't for the past 10 years, but a lot of them are. And I still, identify with that group. Right. So it's a social thing that will last forever. Same thing with whatever your work or now that I go to conferences and I have my, mentors within the financial industry and the people that I work with and see all the time. So it's a community. Right. And when you retire, you leave a lot of that behind. Right. So people will say jokingly, money can't buy you happiness. And then people without money say, well, let me, give it a go. We need a certain amount of money so you're not financially stressed out. And whatever your particular number is, maybe it's $500,000, maybe it's 3 million, maybe it's 5 million. I don't know. Everybody's different, right? And that's what we talk through. But once you are what I would call financially independent, where you really aren't worried about money, then it becomes purpose. Right. And, what am I doing with my day now that I've stepped away and retired from the thing I did for the past, decades? So just something to think about there. A good question to ask yourself. Some advisors, I don't do this unless really I need to with a client. but they ask questions up front like, okay, if you had 1 day to live, what would you do with your time? And that helps you identify your passions, right? Because whatever you would do in that 1 day is something you should probably prioritize over all of your days remaining, right? Or, if money was no factor, what would you do with your time? Those are kind of good philosophical questions, but, think about that. And then sometimes, then you can tie it. Once you have a more clear vision, and you may not have vision, that's okay, right? That's why you're working through it. But more clear vision of what you see yourself look like in retirement, and what are you doing on a daily basis, and what provides you happiness and satisfaction and actualization, then you can kind of tie the financial piece to that. A lot of people retire to play golf and then get bored with golf. A lot of people retire to travel, and then they travel everywhere that they wanted to go, but yet there's 3 decades left in retirement. It's like, well, that was fun, but it was more of a phase than it was my purpose for the rest of my life. So that's why you see a lot of folks, especially, wealthier folks, get involved in causes and, helping people and, giving back and, because that's where they get that source of satisfaction. So something for you to think about, either as an individual or with your spouse, or spouse / family, of what actually does make you happy, and then focus your time and energy on that, especially, thinking about when you don't have a 40+ hour a work week, job, then you're going to have all that extra time for those sorts of things. So overall, that's what I have for you today. So thanks again for checking in. Please continue to submit your questions through email and social media. Don't forget to like and subscribe, but that's all we have for today's show. I'm Steve Ankerstar, and we will see you back tomorrow. Bye.